A portfolio is a collection of different assets that should be managed in such a way so as to maximize the returns and minimize the risk. Good morning, everyone. Our today's topic is CAPM, which stands for Capital Asset Pricing Mechanism. This is another important theory of portfolio management. Before we start this theory, let us look at the two important aspects that an investor look for. One is return and another is the risk. Return can be from the risk-free asset or the risky assets. Whereas the portfolio gives an opportunity to diversify the risk. But diversification of risk does not mean that there is an elimination of risk. So risk is there but it can be reduced. With every asset, there are two types of risk attached. One is unsystematic risk and another is a systematic risk. Systematic risk is denoted by beta and this risk is undiversifiable. It is also known as market risk or explained risk like inflation or earthquake. These things will affect the complete system. So, this risk cannot be controlled or reduced. Another risk is unsystematic risk, which can be reduced by diversification. So, it is also known as diversifiable risk, unique or unexplained risk, which can be reduced if the investor is smart. So, now there are different theories of portfolio management. CAPM theory, Markowitz portfolio theory, arbitrage price theory, and Sharpe index model. I had already made a video on Markowitz portfolio theory, which is also known as modern portfolio theory. You can click the I button or check the link in the description box for the MPT, that is modern portfolio theory. In this video, we will discuss about capital asset pricing mechanism. This theory is developed by an renowned economist William Sharpe in 1970. This model will describe the relationship between the systematic risk and the expected returns when you are investing in a particular stock. So, investors should be compensated in two ways. One is time value of money and another is risk premium. What is risk premium? Risk premium is the extra return that an investor got when he or she invests the money in those securities which are having systematic risk. So, this is the extra return from the securities. So, it is known as risk premium and the risk involved is called systematic risk. The formula of the CAPM model is KE is equals to RF plus beta bracket RM minus RF. What is KE? KE is the required rate of return or cost of equity. So this model will try to find out the theoretical rate of return after investing in any asset which is having the known risk element. So, this formula is basically divided into two parts. The first part is representing the time value of money, which is represented by RF, that is called risk free rate. When you are investing in FD, you will get the return of 4%. And what is the risk? Risk will be 0. So 4% is called RF. And the another part in this formula is called risk premium, or we can say security risk premium. When RM minus RF, then it is called market risk premium, and when RM minus RF value is multiplied by beta, then it is called security risk premium. As you can see here, this is the formula and this is the first part, that is called RF, which is the risk free rate, and this is the second part which is called security risk premium. So in this way, William Sharpe has designed the formula so that you will be able to get the theoretical rate of return of investing your money in any particular stock whose risk element is known. Now we will try to understand the complete theory with the help of an example. Let us consider Ram is investing his money in FD and the returns is 4%. And what is beta here? What is the risk here? Beta is 0. Now, if Ram will invest in market, then we know that the risk of market is always 1. So, the beta is 1 and the return the Ram will get is 15%. Now, if Ram want more returns, then he will invest in any share or any stock like Tata Motors. So he know that the risk element in Tata Motor is 1.2. Now what return I will get if I will invest in Tata Motors whose beta is 1.2. Now we will put all these value in the formula. What is RF here? RF is 4%. What is beta here? Beta is 1.2%. What is RM? RM is here 15%, that is risk of the return of the market. And what is RF? 4%. So now put all the values in the formula. 4 plus beta is 1.2. Just a second. I'll erase all the values. Now what is RF? RF is 4. Beta is 1.2. What is RM? RM is 15 minus what is RF? 4. Now if we'll calculate, the complete value will be 4 plus 1.2 multiplied by 11. The answer will be 17.2%. So, what return Ram will get if he will invest his money in Tata Motors whose beta is 1.2? The returns will be 17.2%. So, in this way, you can calculate the theoretical rate of return of investing your money in any particular stock. So, this is all about CAPM model. Now let us discuss about the different assumptions of CAPM. First of all, investors are the wealth maximizers. They always want to select those investment whose returns are high, and their selection is based on the expected returns and standard deviation. Investors can borrow and lend unlimited amount at a risk-free rate. There is no restriction on the short selling. What is short selling? Selling of the securities that you don't have. So it is also allowed. No restriction is there. All investors have the same expectations from the market. All information is open. Nothing is hidden. All financial assets are fully divisible, means you can buy and sell as much or as little as you like. There is no transaction cost, no taxes is there, and no investor activity will influence the market price. And the last one is the quantities of the financial assets are given and they are fixed. So these are the important assumptions of CAPM theory. This theory will work only and only when these assumptions are applicable. So this model helps in determining the theoretical rate of return when you are investing in any particular stock whose beta is known. I hope now it is clear to everyone that what is CAPM theory and what are the different aspects of this theory. Thank you so much for today. If you are new to this channel, kindly subscribe the channel, and if you are my subscriber, then like, share and hit the bell icon so that whenever I am going to post any video, you will get the notification. Have a great day. Bye bye.